Welcome to the Interreg Italia Malta I Know programme. This is Seminar 6.4, When and How to Access Equity Finance from Private Investors. You can see that 6.4 is drawn from track number 6, which is all about raising finance for your business. So what is equity finance? Well, it's a way of raising cash for the business by selling new shares, which of course is only possible with a private limited company. The founders do not sell their own shares, rather, investors buy new shares and become owners alongside the original founders, with ownership in proportion to number of shares held. It's only possible to attract investors when the business has great potential for growth and has an exit strategy for later sale of the business. When to raise equity finance? Here once again is the shape of finance that we explained in a previous seminar in this series. If the period before profitability is a long one, and the amount needed to cover expenditure is large, then equity finance may be required. This is because debt finance is not possible if the business is unable to repay a loan quickly. So equity finance may be raised in multiple rounds. Why do investors buy shares? Quite simply, they want to make a capital gain later, in which they sell shares at a later date for a price higher than the one they purchased. Just like buying anything for one price and selling it for more money later on. It's a capital gain that they'll be looking for. In order to buy shares, an investor has to be persuaded that the company has an excellent opportunity for growth and a management team capable of achieving the milestones set out in the business plan. So on slide 6, we focus on what do investors look at. For a trading business, then it's profit and loss and balance sheet that will be very important. The business plan and cash flow forecast will also be assessed, usually following a short presentation to potential investors by the management team. For a new business, the P&L and balance sheet are not critical since there are no trading figures available and the company should have few assets, if any, on the balance sheet. Now, what is the most important? Actually, it's the management team. Private investors get approached by many companies seeking to raise equity finance, and the business idea is viewed as important, but not as important as the management team. That's because the key question is whether the management team can lead the company through the milestones identified in the business plan and to do so on time and on budget as defined in the cash flow forecast. Ordinary shares are the most common form of share, and allotment is the process by which people become members of a company. An ordinary share gives the right to its owner to share in the profits of the company, dividends, and to vote at general meetings of the company. As a part owner of the business, shareholders are also entitled to a share in any capital gain if the company is sold. Other share classes. Companies can issue different share classes with different rights, according to their class in terms of such things as voting rights. For example, all publicly traded Facebook shares are non-voting. Priority for dividends and priority for settlement in the event of liquidations. So the rights and obligations of these shares and all shares should be covered in the shareholder agreement, which is a document that should be drawn up by an experienced lawyer. Shareholder agreements are generally private, but they can support public ones, and they deal in more detail with relations between company and shareholders and between shareholders themselves. In some jurisdictions, shareholder agreements are considered as creating a partnership between signatories, but this is not very common. Always have the shareholder agreement drawn up by a lawyer with expertise in the territory that the company will be located. Typical clauses. Shareholder agreements need to be written by lawyers with experience because they have to include important issues. They're able to cover a wide range, of which the most typical are ownership and voting rights, control and management, dispute resolution, and protecting the company from competing interests. Always get a shareholder agreement between founders created before raising equity finance. Ownership and voting rights. These include restrictions on sale or transfer of shares. Individual shareholders are only allowed under certain circumstances unless all shareholders approve. Restriction on using shares as security for a personal loan. Preemption rights. That's the right to maintain a current percentage holding by buying more shares in the event of an equity finance round in which further shares are issued. Tag-along and drag-along rights. The way in which the sale of shares, usually at trade sale, can be enforced when some shareholders disagree. Control and management. Board representation. Typical for a 10% shareholding to carry a right to become a director and hence have a seat at board meetings. And then different majorities for different decisions, otherwise known as protection of minority rights. or protection of minority interests. Specified percentages needed to authorise some kind of action which avoids the greater than 50% dominates issue. For example, changing the name of a company might require agreement between 95% of the shareholders. Dispute resolution. Existence of a shareholder agreement will avoid many disputes and disagreements. It will contain rules on how disputes are to be resolved and requires consideration of potential issues that might arise. Remember that disputes are expensive in terms of time and money, which means it's far better to have a clear mechanism to address them should they arise, rather than having to go to law later. Avoiding being conflicted. The shareholder agreement sets out certain things that shareholders are not allowed to do, things that represent a conflict of interest. These issues might include ability to invest in or be involved with companies that could be considered as competitors, poaching of key employees from the company to another business, irrespective of whether the competitor is a shareholder of that company, sales to the company in a manner that is not on a commercial basis, i.e., the person charging fees above the nominal price to make an unfair profit at the company's expense. That's the end of this short presentation. These are important matters. The shareholder agreement is a key document. Please do look through that again carefully, but always have it prepared by an experienced lawyer, well versed in the territory where the business will be based. I hope that was helpful, and thanks for your attention.